After better than expected economic data kicking off the year and a blistering start for the equity market, where does China go from here? I'm Allison Nathan, and this is Goldman Sachs Exchanges. The world's second largest economy has had a difficult couple of years, plagued by the ongoing property crisis and disappointing economic growth. But more encouraging economic data in recent months and a sharp rally in Chinese equities have begun to catch the eye of investors. Joining me to discuss how the economy and capital markets in China are evolving are my colleagues in Goldman Sachs Research, Hui Shan, Chief China Economist, and Kindra Lau, Chief China Equity Strategist, who are both based in Hong Kong. Hui, Kindra, welcome back to the program.
Good to be on.
Thanks for having us.
Kindra, I'm going to come to you first because obviously we had seen Chinese equities underperforming for a pretty long period of time, but in the last few months, we have seen them rallying sharply. So talk to us about what's driving the rebound.
Well, thanks, Alison. Let me try to put things into context. Now, the China offshore equity market, i.e. Chinese companies listed in Hong Kong and the US, has started to perform well after the Chinese New Year, running almost 30% since the trough in late January, and has been the best performing equity market globally in the past 3 months. And at the same time, the domestic A-share market has done also quite well, up about 15% during that period. Now, at a high level, we think a few key ingredients have gone into the rebound. Number one, better than expected economic growth in the first quarter. Real GDP growth came in at about 5.2%, stronger than consensus expectation. And subsequently, consensus GDP growth for the full year has been revised up. And I guess Hui will have more to say on that in a moment. And number two is really the direct government sponsorship in equities, where, based on our estimate, more than 200 billion RMB has been deployed by the so-called national team to intervene the A-share market. And that has effectively changed the risk-reward perception for investors on Chinese stocks. And number three, this is a theme that we've been emphasizing for quite some time, which is that the policy put option has been exercised, including the pro-growth messaging from the April Politburo meeting and the recently announced equity market reform initiatives from the State Council. So against a backdrop where policy expectation has improved, I think what we have experienced is a process where investors are pricing out the left-tail risks embedded in equity valuations, thereby driving the re-rating recovery over the past month or two.
That's interesting, Kindra, that investors find that as a source of, optimism. I mean, I see your point, less downside risk, but is there any sense, though, that because the government is in there as a backstop and is actually buying, that this is really just propping up the market? And so the rally, isn't necessarily sustainable, driven by fundamentals.
Well, I think, first of all, if you look at who's buying Chinese equities, I think I'll be more specific and divide our comments into the domestic A-share market and the offshore Chinese equity market. Now, as I mentioned, the government has been quite proactive in the A-share market, essentially underwriting a downside put option to equity investors. Although domestic retail and mutual fund buying in the A-share market has been quite modest so far. But in the Hong Kong market, we have observed quite balanced participation between hedge funds and mutual fund mandates globally in the past 1 month, as opposed to just short covering and opportunistic positioning that really dominated the flow picture in the last few market recovery episodes. So what I'm trying to say here is that obviously the government backstop has been quite effective in the Asian market. But if you look at the Hong Kong market, I think the recent recovery has been backed or supported by some fundamental reasons.
Right. And just to be perfectly clear, I know you said this, but we aren't seeing any type of government intervention in the offshore Hong Kong market. It's the fundamentals and it's this mix of investors coming in.
You're right.
Okay. Understood. So, putting that all together, do you think that rally is sustainable? We have seen tremendous upside, as you said. Can fundamentals support the type of move we've seen? And do you see more upside ahead?
Now, after the 30% rally in the Hong Kong market and 15% rebound in A-shares, I think the sustainability of the rally will depend on one keyword, which is delivery. First, it's about delivery of earnings. And the bigger picture here is that, Alison, we are still in an earnings downgrade cycle for the aggregate market, and we need corporate profits to come through to provide more fundamental support to the recovery. But the good thing here is that we have seen some early signs that earnings are improving, especially in the internet and consumer-related parts of the equity universe. And second is policy delivery, and in particular, when and how the promised policy easing regarding the housing market as well as equity market reforms will be implemented. And on that, we think the forthcoming third plenum that will be held in July will be the key to watch, as I'm sure it will attract a lot of attention from investors, as this is probably the venue where investors will get more visibility about policy easing and reforms for the years ahead. So overall, I think the path ahead is still very much policy dependent, but we still think that the tactical market setup looks quite compelling, considering that equity valuations for China remains quite inexpensive. You're talking about 10 times forward earnings for offshore equities and about 12 times for the Asian market, which are roughly speaking one standard deviation below mid-cycle averages. And on top of that, investor positioning continues to be quite conservative. So equity flows have certainly improved in the past month or two, but both hedge funds and mutual fund mandates allocation to Chinese equities remain at the low end of the 5-year range. So putting everything together, we are still looking for about 10% upside for the Asian markets based on our index target for CSI 300.
Understood. And you also mentioned that we are still in an earnings downgrade cycle. So, we do expect to see, as you said, about 10% upside in the index. So you are assuming that earnings are going to improve?
Yes, Alison, we are slightly below consensus in terms of earnings for this year. We're forecasting 8 to 9% EPS growth for Chinese equities, depending on which indices you look at. Consensus looking at about 12 to 13%. So again, we're slightly below consensus. But assuming that our forecasts prove to be correct and valuations do not change from here, so just by riding on the earnings accrual curve, you'll get about 10% upside from the Chinese stock market.
But if you're below consensus on earnings, but yet you have 10% upside, what squares that view?
Well, the simple answer to that is that we expect some further or moderate further expansion in multiples in Chinese equities. Again, even after the 30% rally, MSCI China is still trading at 10 times forward earnings, which is one standard deviation below historical averages.
Right. So you think there's going to be some resetting of evaluation to some extent?
Yes.
Understood. It seems that other forecasters have turned more bearish recently. Are they just less focused on this policy, less optimistic on the earnings side? What do you think is driving those views, or what's the biggest pushback you've gotten to your views?
Well, I wouldn't say we have received a lot of pushback, but precisely to the question you asked about the durability of the rally, I think that's the main concern and the debate or main debate among investors. And again, I think the deciding factor here would be policy delivery. So if the authorities come up with a comprehensive and forceful plan to address the structural overhangs and the structural imbalances, then we think the recovery has more legs to go. But if the policy turns out to be another disappointment, then obviously it's difficult to extend the rally. So I guess the concern out there is really about how committed or how forceful the policy reaction function could be.
Right. And so maybe people who are more cautious are just a bit more skeptical on that policy execution.
Yes.
Hui, when you listen to what Kinger's saying and you observe this market performance, which has been nothing but stellar in the last few months, how does that square with your view on the economy right now?
So in terms of the fundamentals in the economy over the past couple months, I don't think we have seen dramatic changes. With the benefit of hindsight, with market going up so much, I think it tells you at the beginning of the year, sentiment toward China growth or toward risks from the property sector must be super pessimistic. When we came in this year, we said that the government is going to try to get to 5% growth. It's going to be challenging. They need to do a lot of work. But I think a lot of investors are of the view, just think about the headlines we saw day in, day out, housing bust, and there could be a financial crisis following, youth unemployment rate so high that the government stopped publishing the data. so on and so forth. So I think the starting point is a very pessimistic view on China. And then, as King-Jer was saying, once we saw the Q1 GDP number above government target for this year, and we saw not only just official data seems to be better than expected. If you look at exports data, which you can verify with trading partners data, exports in volume terms up 10% year-on-year in the first quarter. And then you look at the travel data during long holidays in China, people are going out and traveling around. And that doesn't seem to suggest consumption collapsing amid this big housing downturn. So I think your starting point is very pessimistic. And after looking at data and evidence and realizing perhaps it's not as bad as people feared, and I would think the fundamentals, they are weak, but they're not deteriorating. It's just expectations moving up from a very low level to where the reality is. And that might be enough a factor driving up the market performance.
And I think what you just said is very important in the sense that there does seem to be some skepticism about some of the official data, but you are seeing some of that strength that's come through backed up by other indicators that, we feel confident are reflecting a pretty realistic picture of the situation. When we think about the go forward, we always think about the first part of the Chinese year with New Year and a lot of different events that could stimulate the economy. If we think about the go forward, do we think that the better growth performance that we've seen can be sustained?
It's interesting when we looked at our forecasts for this year's growth, we have been above consensus for quite some time. When we introduced 2024 outlook, we were above consensus and we said, if the government is aiming for around 5% growth, one way or another, they will try to deliver it. You put it differently, we are seeing not as much uncertainty on the top line GDP growth number because of the system works such that once they have a target, they're going to work toward it. But there's tons of uncertainty in terms of how the composition, which part is going to be outperforming, which part is going to be underperforming. For example, how much is exports going to grow or slow? How bad will the property market be? How much the government is willing to spend on infrastructure to offset weakness elsewhere? The compositions are very hard to predict. And fast forward standing in May right now of 2024, exports are even better than our relatively constructive view coming into the year. But housing was worse than we expected. If you look at the top 100 developers reported data, first quarter, their sales down 50% year on year. So ironically, because of the property sector has been so weak, perhaps that's one catalyst for the government to finally decide to accelerate easing or increasing easing. Hence, that's another catalyst for investors to focus on China and become more positive on Chinese risk assets. And also because exports have been so successful, we're hearing more noise about tariffs, trade tensions, and so on. So, going forward, the dynamic will be very interesting to watch because the reality of housing is very weak, but the bad news becomes the good news and government is doing more. Whereas on the trade side, trade tensions clearly on the rise, but at the same time, Chinese exports are holding up very well.
And Chinese policymakers have actually been pretty innovative lately in thinking about how to tackle these property market problems. Talk to us about what they've been doing and the implications of that.
I think this is an important shift in mindset. I think previously the government was of the view, if you read documents, they always say we want a market-driven solution to the property sector problems. But in reality, property is the largest sector in China and is in a sharp decline. And market-driven solution will not work. Market-driven solution without government intervention, think about it as a bank. You would not want to lend to developer or real estate sector, no matter how many times the policymakers are urging you, because you don't want to make a loan that go bad and you have to hold the bag for the bad loans. And if you are a household, you don't want to buy property because you think the prices are still going down. So the market-driven solution doesn't work. And I think the critical shift we saw over the past couple months is that the central government needs to do more. we need to get rid of these excess supply. We need to have a government coming in, buy these empty apartments to rebalance the market. We have too much supply and not enough demand. So we need to boost demand and reduce supply, accelerate the timeline for prices to find bottom. So I think that thinking is correct. And as Ginger was saying, now the question we're asking is implementation, delivery. Are they going to put in enough money in this program to rebalance the market soon enough? And are they going to be able to prevent people with multiple empty apartments all of a sudden coming in thinking that this is a window opportunity for me to sell my extra apartments? So there are a lot of implementation questions, but I think the mindset shift that we need to deal with this excess supply problem is a very important one.
Right. And just to be perfectly clear about this initiative they have announced, they essentially, it seems to me that the central government is proposing that they fund local government purchases of excess housing supply. Is that right?
But not there yet. So far, it still is a local-based program. Different cities are experimenting with different schemes. In some cities, it is that local government and local government financing vehicles come up with money to buy a property from someone, an old property, and then give them money for them to buy a new property from the developer. So the trade-in or replacement demand type of a program. In other cities, they might be giving you some kind of a discount. If you buy a property, we'll try to cut your taxes or fees. In some other cities, it could be the local government buy these empty apartments directly from developers and then turn them into some kind of a social housing or other uses to take them off from the normal owner-occupied housing market. We're still waiting for the size, the location, and the exact design of these programs. But end of the day, we believe that central government is the only entity has the capability to provide the funding and push this through. Local governments are financially constrained. So it is a part expectation and part ongoing at the local basis.
Understood. So, Ginger, another area where Chinese policymakers have been active are in the capital markets. We have had this 9 measures, which is intended to bolster capital markets. Talk us through what the implications of that could be.
So, Alison, I think the 9 measures quite significant and consequential to the stock market. Specifically, just a month ago, the State Council announced the once every decade policy opinions, aka the 9 measures, which will guide the development of the Chinese capital markets in the years to come. So overall, we see 3 key policy objectives from the document. A, strengthening supervision. B, raising the quality of listed companies. And C, enhancing investor protection. And overall, these policy objectives or focuses are largely consistent with the broader economic and strategic directions set out by President Xi and other senior policymakers in China. Now, in terms of the market implications, we estimate that we could potentially get 40% valuation gains in our blue sky scenario, assuming that Chinese equities can match the existing global leaders on 3 dimensions: shareholder returns, corporate governance standards, and long-term institutional investor ownership in the stock market. And in a less aggressive scenario where China only improves to the regional averages along these dimensions, the potential re-rating gains could still reach around 20%. So in other words, we believe that there is quite significant policy-driven upside or value to be unlocked from the stock market if the necessary capital market reforms actions come through.
Right, but that's going to be a slow process, a long process. I mean, when would you see some of that actually being realized?
Based on our recent conversations with regulators, I think the policy announcement momentum will be quite strong in the months ahead because they recognize that they need to come up with some specific and concrete measures to really deliver the promises they made to the market. So from our perspective, I think more specific policies on improving shareholder returns, on raising dividend payouts or encouraging more buybacks are underway.
Got it. But on the U.S. side, President Biden has had a busy week. He's announced sweeping new tariffs on a range of Chinese imports. So, Hui, does that matter for the Chinese economy?
The Biden administration just announced after the Section 301 review, they announced tariffs on Chinese goods worth of $18 billion US. And the type of products include mainly EVs, batteries, solar cells, semiconductors, and some other strategic items. By itself, this announcement is not a huge deal for Chinese economy because just putting things in perspective, China exported around $500 billion US of goods to the US in 2023. We're talking about $18 billion US of products being tariffed. Even that $18 billion, not everything is effective 2024. Some of the items, if the US is having a hard time to source alternative suppliers, the effective date is 2025, 2026. So in that regard, this is not an immediate and important negative impact on China growth per se. But I think the fact that the Biden administration is raising tariffs, and then we have upcoming election, and in the scenario, Trump wins the election, and he has suggested that he would increase tariffs by 60% on Chinese products. That would be a much bigger deal for China. And we estimated that if without other offsets, then it could cumulatively subtract 2 points of GDP from Chinese economy. In that scenario, the 60% tariff on everything China exports to the US. So certainly a significant downside risk. At the same time, I would also say on the China side, looking at experience from 2017 to 2023, I think the reaction function might be slightly different. So after President Trump took office in 2017, he started various investigations on trade-related issues. And in early 2018, the trade war started. And during the span of 2018 to 2019, the U.S. imposed tariffs on over $300 billion worth of Chinese exports to the U.S., and the rates varying between 7.5% to 25% on these products. And in 2018, 2019, China probably was more nervous about downside risk to the economy. This because this is the first time of the U.S.-China trade war. But after 6-7 years, Chinese exports are doing fine. U.S. trade deficit continue to widen. Chinese trade surplus continue to widen. So I think this time around, policymakers in China may be calmer and may not react exactly the same way as they reacted in 2018, 2019. And another point to make is that Chinese products are just very competitive, a lot of different dimensions and different products. So in the near term, we're still constructive on Chinese exports and exports contribution to GDP because we don't think it's that easy to stop Chinese exports. In the long run, if Chinese trade surplus continue to grow and this trade imbalance continue to accumulate, I think more trading partners will be pushing back and we're going to see more tariffs, higher tariffs from more countries and to rebalance global trade flows. But in the near term, we don't think that Chinese exports will be hugely impacted.
So when we put this all together, Hui, Kinjer, what does the risk reward look like for investors at this point?
I think from a fundamental point of view, I would say the good news are not that good and the bad news are not that bad. Meaning at this point, the investor sentiment toward fundamental may be more in line with the reality. Even though the central government is willing to spend money and come up with a credible package to support the property sector, we're still talking about a huge housing downturn in China, which will take time to see fundamentals materially improve. But when I say bad news are not that bad, because if you think about where the housing market is versus where house consumption is, they divorced. If you still use the mentality of in the housing downturn, there's a negative wealth effect, consumption is going to collapse, and the financial system is going to implode, don't use that framework to think about the Chinese property market. The bad news is not that bad because we are in a very different dynamic. Consumption can continue to carry on without a booming housing market. So I guess what I'm saying is that we feel comfortable with our 5% real GDP growth forecast this year and think risks at this point are more balanced.
Kinjer?
So for the equity market, certainly the risk reward profile isn't as attractive as it was 3 months ago, given how much the market has rallied. But looking ahead, if the policy momentum continues to be strong and look at where we are on valuations and investor positioning, we still believe that the tactical setup for further gains for the offshore market remains quite compelling. But more strategically, we still feel more comfortable with the A-share market because this is the market where the sensitivity to policy easing has been relatively higher than the offshore market. And from a liquidity perspective, I think you are talking about more sticky, more anchored capital in the A-share market as opposed to the Hong Kong market, which is still very much dominated by foreign investors.
So I'm taking away from this that, look, I like how you put it, Hui, bad news is not always so bad because there are other parts of the economy outside of the property market that have shown to be humming along reasonably well, and reasons to also be somewhat positive on the equity market, although recognizing it's already run up a lot. Hui, Kinjer, thanks so much for joining us.
Thanks for having us.
This episode of Goldman Sachs Exchanges was recorded on Thursday, May 16th, 2024. I'm your host, Allison Nathan. If you enjoyed this show, we hope you subscribe on your platform of choice and tune in next week for another episode. And if you want more insights from Goldman Sachs, make sure to visit gs.com and sign up for Briefings, a weekly newsletter from Goldman Sachs about trends spanning markets, industries, and the global economy. Thank you for listening. The opinions and views expressed in this program may not necessarily reflect the institutional views of Goldman Sachs or its affiliates. This program should not be copied, distributed, published, or reproduced in whole or in part, or disclosed by any recipient to any other person without the express written consent of Goldman Sachs. Each name of a third-party organization mentioned in this program is the property of the company to which it relates, is used here strictly for informational and identification purposes only, and is not used to imply any ownership or license rights between any such company and Goldman Sachs. The content of this program does not constitute a recommendation from any Goldman Sachs entity to the recipient and is provided for informational purposes only. Goldman Sachs is not providing any financial, economic, legal, investment, accounting, or tax advice through this program or to its recipient. Certain information contained in this program constitutes forward-looking statements, and there is no guarantee that these results will be achieved. Goldman Sachs has no obligation to provide updates or changes to the information in this program. Past performance does not guarantee future results, which may vary. Neither Goldman Sachs nor any of its affiliates makes any representation or warranty, express or implied, as to the accuracy or completeness of the statements or any information contained in this program, and any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed.